Hello everyone, and a warm welcome to this webinar, Technical Indicators and the Euro. If anybody has any problems in regard to hearing me or my co-host during the webinar, please just send us a message via the chat box and we will do our best to fix it for you. So in this webinar, my co-host Neville Hornsey and I will run you through how to locate and use trend-based and oscillator indicators on the new ActivTrades platform and the best ways to incorporate them on the price charts. We'll also be discussing our respective forecasts for the Euro-US dollar pair while examining the recent slowdown of the German and the French economies, and also our predictions for some of the popular Euro-related currency pairs. So we're now going to have a quick run through in this live webinar of our roles. So my name's Nathan Batchelor. I'm a fundamental and technical analyst. I previously produced the popular video series, the biggest market movers, and have a background in trading foreign exchange. And I previously worked in the hedge fund industry as a trader. I'm now going to pass over to my colleague Neville, who's going to give a brief introduction of himself.
Good afternoon. My name is Neville. I'm a macro intraday trader, which means I look at the bigger picture on the charts and then close out at the end of the day when I'm trading. I trade mainly the CFD majors, and I keep an eye on the commodities and indices. So yeah. Right,
so now we're just going to run through the objectives of this webinar. So how to use trend indicators on the ActivTrades platform, incorporating oscillators to the chart, the key Euro-US dollar levels to watch, the German and French macroeconomic outlook, and single currency predictions related to numerous Euro-related currency pairs. So if you can just quickly read this risk disclaimer before we begin. So the first section that I'm going to be covering is how to use key trend indicators on the new ActivTrades platform. So first of all, you'll see when you go into your ActivTrades platform, you'll go towards the indicators section. It's being highlighted for you, and once you go in there, you will see a section that says trend. Once inside the trend section, you will see the simple moving average, the exponential moving average, the weighted moving average, the smooth moving average, and the directional moving system, and the Ichimoku cloud. I'm just going to briefly give you a little run through of what each of those indicators are, and then I'll go through the Ichimoku cloud in more detail. So the simple moving average is a rhythmic moving average calculated by adding recent closing prices and then dividing them by the number of time periods in the calculation average. A simple or a rhythmic moving average that is calculated by adding the closing price of the security for a number of time periods and then dividing this by the total same number of periods. Short-term averages respond quickly to changes in price, while long-time averages are slow to react. The exponential moving average is a type of moving average that places greater weight and significance on the most recent data points. The exponential moving average is also referred to as the exponential weighted moving average. A weighted moving average gives you a weighted average of the last price where the weight decreases with each previous price close. This works similarly to the EMA, the exponential moving average, but you calculate the WMA differently. WMAs, or weighted moving average, can have different weights assigned based on the number of periods using the calculation, and you can customize the weighted moving average more so than the simple moving average and the exponential moving average. So now moving on to the smooth moving average, is a sort of cross between a simple moving average and an exponential moving average, only with a longer period applied to it. The smooth moving average gives the recent price closes an equal weighting to the historical ones. The calculation does not refer to a fixed period, but rather takes all available data series into account. This is achieved by subtracting yesterday's smooth moving average from today's price. Adding this result to yesterday's smooth moving average results in today's moving average. So now I'd like to quickly talk about the directional movement system. The directional movement system is composed of 3 indicators whose purpose is to help ascertain whether the market is trending and provides traders with signals for trading the trend. The system consists of 3 lines: the positive directional indicator, the negative directional indicator, the average directional movement, the ADX, which indicates the degree of trend strength. The directional moving and the ADX indicators should be used simultaneously to help evaluate whether a currency is in a trending or trading range environment, and importantly, identifying an impending change in trend. So it's quite a useful indicator. The Ichimoku cloud is a favorite of mine. It's a collection of technical indicators that show support and resistance levels, as well as momentum and trend direction. It does this by taking multiple averages and plotting them on a chart. It also uses these figures to compute a cloud, which attempts to forecast where the price may find support or resistance in the future. The Ichimoku cloud uses moving averages. They are different more than typical moving averages in the way that simple moving averages take price closes, adds them up and divides that by the total by how many price closes there are. In a 10 period moving average, for example, the closing prices for the last 10 periods added then divided by 10 to get them. Well, the Ichimoku cloud is based on highs and lows over a period and then divided by 2. Therefore, the Ichimoku cloud will be different than the traditional moving averages, even if the same number of periods are used. And you can see here in front of you this Ichimoku cloud as an example for the euro US dollar. And you can see just using on the simple 4-hour time frame, you can see that the euro last week started to show some bullishness as it broke above the 4-hour cloud. So it's quite a useful indicator on the 4-hour horizon for gauging short-term strength. And we can see once it started to break above that cloud and take out the key lines, you can see that it's continuously moved higher, and we can see that the euro has definitely turned bullish in the short term. We can see that the key areas of support are now located around the 113.40, and also you can see around the 113.25, which actually coincide with some other technical analysis that I've done. And you can see that the Ichimoku cloud has calculated that for you fairly well by itself. So it's a very useful indicator on any time frame. So now I'd just like to pass over to Neville, who's going to be handling the next segment.
Okay, so I'm going to be talking about incorporating the oscillators that are available on the new ActivTrader platform onto the charts, and they give a broad selection of either volatility, trend-based, or you'll see the oscillators are quite good for ranges. So if I just quickly go to this chart, to find them, the oscillators are located in the similar place to the trend-based indicators. Come down to oscillators, and then here you go, you've got the average true range, commodity channel, elder force index, and so on. I'm actually only going to talk about 3 of these: the average true range, MACD or MACD, and the relative strength index, which is also commonly referred to as the RSI. If I just go back to a slide, you can see the maths here. I'm not going to try and explain it all because I'm not very good at maths, but all these calculations are made either on the high, the low, the close, or an open and price, things like that. If I go, yeah, actually I'll stick on the slides. So if that's the maths that create the ATR, the actual outcome here you can see is a more pleasant to the eye reading. The ATR is on top. It looks a bit like a mountain chart here. The MACD in the middle has got this band of a moving average and a histogram, and the RSI itself is again a mountain type chart on the new ActivTrader platform. But this one, the RSI has an upper and lower bound, and some traders will say that is a sign of oversold or overbought in relationship to the price. So if I just go back to the trading platform, right, this is the average shoe range as you find it on your platform. Now, for a lot of traders, they'll be looking for breakouts, they'll be looking for trends, and they're looking to not necessarily trade a breakout when it's not trending. And for a trend to be initialized, you kind of need a bit of volatility, and the ATR is good for showing how much volume and volatility, market participation there is. The higher the ATR, the higher the range, and the actual ATR is a measure of volatility based on a range of prices. So here, if you click on the cogs of the ATR, you can change the period that it works out how many true ranges to calculate, and it's over a 14 period as standard. Now, I'll just close this. If you're looking for a move from swing to swing, then the ATR probably doesn't really matter. But if you go to a lower time frame, you can see that if you're looking to, I'm just going to draw on the chart, it's easier. If you are looking at this range here and you're looking for a breakout to the upside or maybe to the downside, if you see that the ATR itself is quite low, then there's not a lot of volatility. So you might have to wait a long time for this breakout to happen. Also, you might find that there's resistance at previous highs or support at previous lows. Until you see the ATR pick up beyond this sort of consolidation period here, that is when you can see that the highs are taken out a lot easier and support is found, and then again the highs are taken out. So this trend continues as the ATR increases. So that's one way of using ATR for volatility. It's always a bit sketchy to trade when there's a possibility of the like I say, the highs holding here. It could have easily come down and then done this because of the low market participation. Much better to trade as the ATR increases here and here. You see that's a decent breakout and then trend continues up. So that's how I use the ATR. Now I'm going to clear that off. The next oscillator I'm going to talk about is the MACD. And the MACD is really good in a trend. And after a while, you'll also get to see that if you were to put a couple of EMAs on your chart, let's do this. Maybe the 12 and the 26. I'm going to attempt to change the color of the 26. Right, just going to zoom in. So essentially, the MACD, or moving average convergence divergence indicator, is two calculations. It is you're calculating an EMA of standard periods 12 and another EMA 26. And as the 12 moves away from the 26, the MACD will also expand. Up here, you can see, let's get my pointer. So something like this cross here, you see that the MACD is opening up, and then here it's closing down. And you can see the histogram here in green shows when the 12 is above the 26 on the MACD, and it turns red at this cross point here, and yeah, until the next cross here. So the way I use it is for trends. If you were to put your oscillators into two categories, one being an oscillator with a zero signal line, which is shown here by the red and the green flipping over this dashed gray line. You could say it's a positive trend when the histogram of the MACD is green, or you could say when this moving average is above the red one here. And vice versa, it's a downtrend when you're showing the red histogram or the red band here. But it's only really good on the higher time frames because you don't have to worry about the choppiness, the volatility, the spikes and things like that. You get a slightly smoother curve. And if you were to use the MACD within a range, a bit like here, you might actually start to get false signals. So here you can see the histogram is very small. The bands are very close together, which is the representation of the histogram, but in the moving averages. And here you also see that there's not a lot of movement within the price. So if you were to do that on a smaller time frame, you would get chopped up quite quickly. Whereas at least here, you can sort of say on a 4-hourly time frame, these moving averages have crossed there, and then they cross again here. Maybe my hypothesis is that the overall trend is up, and I will take a signal on the MACD when it turns green. So you would have, if I just clear this out. So at the start of your trading week, you could say I saw a cross here for bullishness, and then here you see we're green. So maybe you take that trade and you're happy that it breaks out from this high. When the MACD crosses below the signal line, maybe you use that as a way of taking profits or getting out of your trade. And then you take another long at the next positive crossover on the MACD or the next green histogram here. And then you follow that up. And again, take profits maybe here or when your moving averages actually cross. Essentially, you want to be using the MACD as a trend indicator. So if you've got another way of deciding if the market's going up or down, then MACD is quite useful. If you've got a market that's going sideways, I would say MACD is not useful. So hopefully that gives a little bit of clarity on how I would use the MACD. I'm just going to clear this one off. All right, the next oscillator that I'd like to use is the relative strength index. And this I probably would use on all time frames. And if I just make it a little bit larger. So in an ideal situation, in hindsight, you would look at the peaks and you look at the troughs like this, and you would see that they correspond to when the RSI has also been in a overbought or oversold situation, which is great in a sideways market like this or a range. Not so good when you're in a massive trending market, because traders will invariably look at the overbought signal and say, in the past, when I've seen that turn, well, in this situation, when I've seen this turn cyan above the 70 line, if I take a short here, it will come down. I can tell you now that the amount of times I've seen that happen, but you've got a trending market, and that just means there's more upside to come, and that's when you start seeing traders get squeezed. So yeah, I would use the MACD for a trending market, and when you see that the trend has changed and there's some consolidation before the next trend, maybe switch over to the RSI and then try and pick off trading the highs and the lows of your channel. So maybe wait for the first 3 signals, 1, 2, 3, and then if you're thinking, yes, probably still in the channel, to be safe, I'll wait till we get to the highs. And then you also sort of see that the RSI, or the relative strength index, is also overbought. You've got a better chance of seeing something come down to test the lows again. But if you are, like I say, in a trend, you'll just find that this just means there's more upside to come. Any questions on that, Nathan, or anything else I should explain?
Yeah, I've got quite an interesting point, I think, to raise with the MACD. In your opinion, Neville, do you think it's better to take the signal at the bottom of the MACD when the MACD indicator starts to make higher highs, or do you think it's better to take the trade when the MACD indicator has actually moved into positive territory?
For me,
Yeah,
I would say, well, basically all indicators are just indicators. So I've tried to follow them religiously in that way, where you sort of say, if it's below the signal line, look for buys and sell for buys, and when it's above the signal line, only take sells. For now, I'm going to say, if you've identified a trend, then I would be looking for basically the signal line to cross over. I mean, that's
sure,
what I look for now.
sure,
I know people will say that, or maybe say that, if we just get the MACD up. Right, so let's find right, so I'm going to say that in retrospect, that was a range, that was a trend, that was a pullback, continuation of a trend. So yeah, the best way to do would be to back test. You find a range and then a breakout of a range. Where was the
sure.
MACD at the time? The MACD was above the signal line. Or, do you call it MACD or MACD?
I think either's fine, to be honest with you. Yeah,
Right. Okay, I'll stick with MACD then because it's easier to say. Uh, we're above the signal line, which is good. We're ranging, so we've got like some lows that are joining up, some highs that are joining up. I'm waiting for a breakout of this range because I'm a trend trader. I see that we break out the range. Where's the MACD? It's here. It's above the signal line. The short term, the 12 is below the 26, so everything's turned red here. Yeah, take a short. So
sure.
yeah, maybe if it's below the signal line, if I just clear this again, it's a bit messy quickly. So when we cross below the signal line,
Yeah,
we're about here. So we broke out the range. We were happy to take the signal from the MACD and everything's red. It's all good. That's where you want to get in for a breakout.
yeah.
I don't know if I'll be taking more bearish trades below the signal line in this situation.
Okay,
However, this is on a 4-hour time frame. So maybe you go down to a smaller time frame whilst the H4 is bearish, start looking for the pullbacks on the MACD, on a smaller time frame. So yeah, using like a higher time frame as your guide for trend, and then taking the signals as they're above and below the signal line on a smaller time frame.
sure.
That's probably how I would do it if I was to
Cool.
trade it solely. But for me, these indicators are kind of confirming my original hypothesis based on the price action. So if I feel like we're in a trend, I'll just quickly glance at the MACD and say, does that confirm? And if I think I'm in a range, start to look at that RSI to see if that's in an overbought or oversold situation. because I don't want to be thinking I'm in a range and I want to buy somewhere if the RSI is saying it's above the 70 line. It just invariably doesn't work.
Sure.
So it's just confirmation, really. And the ATR, yeah, if you see like rising volatility, then you've got a better chance of breaking those highs or breaking out of those lows in a range. So yeah, that kind of how I make it work.
Brilliant.
Right, so back to the slides.
Yeah. The next section that I'll be discussing, I'll be giving a brief prediction for the key Euro US dollar levels to watch in the short term. So I think the euro has caught a lot of people by surprise so far this week and also last week. According to my analysis, when the euro US dollar hit the 111.70 region, that was a long-term Fibonacci level from the lowest point of around 2017 right up to where Mario Draghi announced quantitative easing. So that was a key Fibonacci, a long-term Fibonacci level. So we've probably seen a bit of profit taking there, and that area as well. When we started to hit that area, it also kind of coincided with the FOMC taking a more dovish stance and obviously making some adjustments to their policy language. So that now brings me on to the FOMC policy meeting this week, and the euro has been advancing, but I don't think we're going to see any big breakout moves in the euro until we see what the euro is going to really do, or the dollar is going to do, rather, following the FOMC statement. And obviously we're going to see what the Federal Reserve has to say about the recent spate of weaker than expected data coming from the US economy. Also the weak inflation, and obviously they're going to address the non-farm payrolls job report from last month, which had a worse than expected headline number, but also had some positive elements inside it. So looking at the technicals for the euro US dollar in the short term, I've identified the 113.60 level as being an area that's key. It's been key for quite some time when trading the euro US dollar this year. So keep your eyes on that 113.60 level. If we do start to break above there, I would expect we're going to advance towards key trendline resistance. So you can see here on the daily chart, it's worth noting that the euro has broken above its 200-day moving average. So that is located around the 113 area, but I've got the 112.90 area as more reliable support. So we should expect the short-term bullish bias this week in the euro to really remain intact while we're trading above the 12.90 level. So if we do get a breakout above the 113.60 level, what's going to happen? I would expect we're going to advance towards trendline resistance here on the daily chart, and that's located around the 114 level, and we've also got some more resistance up there around the 114.50 level. So if we do break above the 1400 level, then I would expect an advance towards the 114.50 level. Of course, this is all depending on the Federal Reserve. We know the euro data is weak. We know Brexit's hanging over the euro, so we're probably going to see dollar-driven moves this week. Again, looking at the downside now, or switching to the downside, underneath the 112.90 level, keep your eyes out for the 112.60 and the 112.15 levels. So these are the key support areas. Again, unless we break above the 114.50 level, we should expect the euro is probably going to trade between that 112.90 to 114.50 level. In the section towards the end, I'll be looking at longer term euro forecasts, and I will have a slightly longer term view for you on the euro US dollar, the euro Japanese yen, and the euro GBP. Any thoughts yourself, Neville, on the euro US dollar in the short term?
Euro US dollar short term, no. It's coming up to some resistance. Yeah, like you said. So I'm looking at this area here. and I'm hoping it will come down to this area here. I mean, but at the moment, it's all looking very bullish.
Yeah,
Like today, it's
yeah.
it just since what day is it? What is the date today? It's so from yesterday, we found a low at support. We're currently on my charts, as I look at them, we are currently just below monthly pivot. So I'd imagine that will get tagged. It was it was at the start of March, we came through the monthly pivot, and we're basically just finding that as resistance now. So it's the channel from the 7th of March till today looks bearish, which is why I wanted to be bearish. But until we tag that monthly pivot, I keep getting stopped out. Which is annoying. But yeah, that's I want it to come down so badly, but it just refuses in the current market. And I reckon maybe FOMC, like you say, will be the turning point. Maybe the dollar will just somehow gain some strength, which would be great.
Sure, great. Okay, we'll now move on to the next section where Neville has got some really interesting facts for you on the French and German economies.
All right, I'm gonna try and make them as exciting as possible. Rightio. So German and French macroeconomic outlook. Where to start? All right. So the first thing is to know that the Germans and the French are, two of the most influential parts of Europe in terms of monetary and economic policy within the EU. Germany is the most influential. You need to keep an eye on these two as they create policies that influence trade within Europe and the European Union, and also when it comes to the trade talks between the USA and China. Germany always has some things to say about that. And recently, in terms of Europe and their trade, they just, as of the 1st of February 2019, they had an agreement come into act with Japan. They got a Japan Economic Partnership Agreement, which means that Europe will find it a lot easier to export into Japan, whereas before there was trade barriers and things like that. So maybe the German and French economic data will start to pick up now that they can trade a little bit more freely with Japan. Going back to how influential Germany and France are, they are both founding members of the European Union. And when we refer to the European Union or the EU, we're basically talking about a political and economic union between 28 countries. And within those 28 countries, they've essentially formed a free trading, tariff-free trading market. It wasn't always 28 countries. Essentially, there were 6 founding countries, and the EU, as we know it now, was born out of the European Coal and Steel Community, otherwise known as the ECSC. And then that was superseded by the European Economic Community, the EEC, which is what Great Britain chose that you would like to join in with. In terms of the political side of things, the 28 countries abide by EU law, and within the 28 countries, 19 member states are part of the Eurozone, and the Eurozone essentially refers to those that choose the euro currency as their base currency. So there's all sorts of EU things, but we're going to talk mainly about the Eurozone and the euro because we trade foreign exchange. The euro is the second largest and the second most traded currency, other than the US dollar. So if you are a trader that trades the euro dollar cross, then you're trading the two largest assets within the FX market. Some little known facts maybe that out of the world, there are other countries that use the euro. 14 African countries peg their currency to the euro, and unsurprisingly, those African countries were actual former French colonies. Iran, they prefer euros for all their foreign exchange transactions, and that includes oil. Essentially, the relationship between Iran and the US is, well, we could describe it as frosty, and the Iranians obviously prefer the euro over the US dollar. And that's quite significant, because when Iran brings oil to market or is having to buy oil because of US sanctions and things like that in the past, it's probably a good idea to keep an eye on the euro, because they're going to have to fund it through euro. Okay, so to use the euro as your base currency, countries have to sign up to some rules, some fiscal rules. And one of the rules is that your country's annual budget deficit has to be less than 3% of your GDP. Another rule is your debt as a country, the GDP ratio must be less than 60%. So debt to GDP ratio must be less than 60%, of which Germany comes in at 63.9% and France comes in at 97%. But as you might have, well, if you listen to the financial news, you might have heard of Italy at the end of last year. They were always being told off by the Europeans because they refused to amend and align their budget forecasts to those rules. And I would imagine if Italy or France were to start to fail, then that would have massive implications on the ECB's policy and the overall health of the EU. So you have to keep an eye on those sort of things when you're trading the euro or any of the euro crosses. So yeah, keep your eye out on the relationship between those debt to GDP ratios. I was going to talk about the most influential people within Europe, but as we're talking about France and Germany, the German head of state is the Chancellor of the Federal Republic of Germany, and she is Angela Merkel. And big news is that in 2021, she has indicated that she will not be looking for re-election. So you start to look at possible replacements for her, because she has been a stable influence on the euro area, and the next person that comes in might have different ideas of how to go about doing business. And in France, the current president is Emmanuel Macron, and he's been in the job since 2017, and unfortunately finds himself under siege every weekend. So if they're going to keep doing that, maybe Emmanuel Macron will have to step down, and then that will cause a bit more disruption to France, which will then maybe lead to different fiscal policies. And yeah, so you just need to keep an eye out on those two people and their replacements. And in terms of the euro, the European Central Bank, or the ECB, that is currently headed up by President Mario Draghi, and even he is to step down soon. So again, the euro policies may change dramatically when the next person comes in. When we're looking at influential areas of macroeconomics, we often look towards the indices. And if you're looking at a French or German index, you're essentially looking at the DAX or the CAC. So if I just quickly go over to the market on ActivTrades, the DAX is the index on the Frankfurt Exchange, and ActivTrader here uses the ticker symbol GER30, and it's quite easy to remember, German and 30 leading companies within that index, of which not all are German, I found out recently. If you wanted to keep an eye on the French, you'd look for the FRA 40, and you can see that's the CAC 40 cash index, and I'll just pop a chart up so you can see it like that. Yeah, all the indexes are going higher and higher and higher. S&P is just taking out some key highs, and it looks like the French are going to do something quite similar. Probably take out those. Right, going back to my notes. Right, macroeconomics and German and French relationships. It's quite hard to split them because essentially they're all Northern European, so they've got a similar base of people. They both use the euro as their currency. They have similar fiscal policies. They have similar inflation and interest rates, essentially. If I just go to the next, come on. Yeah, so French GDP growth rate is 0.3%. German GDP growth rate is 0%. So there's little growth within the German and French economies. The unemployment rate in Germany is low. It's 3.2%. UK is actually 4%, so we're only just above that. But the French unemployment rate, is 8.8%, so double that of the UK. So unemployment is still quite low, but growth is low. So that's kind of on the balance. The German economy is an exporter, whereas the French overall economy is an importer or net importer. So the Germans like it when the euro is low because it makes their products more saleable. And obviously, if the euro is higher, then the French can buy more stuff for their money. In relationship to us, the UK is a net importer from Europe. We exported about 300, or just under 300 billions worth of goods, while we imported from Europe over 300, with about 340 billion pounds worth of goods from Europe. So yeah, we probably buy a lot of German product. This actual chart here, the German manufacturing PMI, you can see, well, since the end of 2017 has been on the decline, and as German manufacturing is a massive part of their exports, that's quite worrying. And not only is it worrying, it's actually gone below 50 the last 2 months, which means it's actually sick. And it's better for the German, well, it's better for the whole of Europe when German's manufacturing PMI is above 50 and on the increase, rather than, as we're seeing here, on the decrease. If they're the well, essentially they're the net contributor to the EU budget, they take the least amount out of the European Union, and they are the monetary backbone to Europe in terms of like producing. So the German manufacturing PMI is an indicator to watch, and along with slow growth, you kind of, well, economists are saying that Germans are in a technical recession, so, or very nearly. So you're going to start seeing these exports of cars, vehicle parts, and machinery maybe declining more, which will be bad for industry overall. And you kind of need someone to pick up globally some more euro produce. And if you've got people like Donald Trump saying that the Europeans have traditionally treated America poorly in terms of tariffs and being fair, there's an international trade agreement that was being pushed by the US a couple of years ago. The Europeans Council and Parliament rejected that eventually. You kind of need Europe to do more business and quickly, because they're going to get sicker and sicker and sicker, because traditionally the Northern Europeans have been the people that are being propping up the Southern Europeans. So you're thinking of like Spain, Greece, Portugal. You know, they rely on the Germans and the French and the Italians to be a thriving economy. Here's the CAC and the DAX, or the FRA 40 versus the GER 30. And you can see that both of them follow each other quite quickly and similarly. And in terms of that side of macroeconomics, that's all I have. Have you got any questions on that, Nathan?
No, that's great, Neville. Really well explained there, I think. We're running out of time, everybody, so we're just going to run to the single currency predictions quickly, and we're going to be running through specifically the Euro US dollar, the Euro Japanese yen, and also the Euro against the British pound. So I'll start with the Euro US dollar weekly chart, if that's okay. And we can see here on the Euro US dollar weekly chart that the Euro US dollar has formed a bearish head and shoulders pattern, and you could say that the neckline, for me anyway, is sitting around the 115 level. So from that, I'm surmising that there is the potential, at least, for the euro to drop quite significantly while it's trading underneath that 115 area, or the neckline of that bearish pattern. So that's something that we should bear in mind when having a look at the Euro US dollar, in that it has got the potential for significant weakness. Again, I highlighted the key Fibonacci level earlier at 111.75. I'd like to say that below the 111.75 area, the next key technical level below that is actually located around the 110 level. So you've got quite a significant drop to come on the euro if bears can take out that 111.70 area. I'd also like to point your attention to the 113 level. The 113 level, if traders will remember, it's a former important swing high from the American election. So price actually came up to the 113 level, and then as it was becoming clearer that Donald Trump was going to become president, we saw the euro tag the 113 level, then fall to a new multi-year low around the 103.30 region, and then once it come back up again and broke the 113 level, we've seen the euro US dollar then obviously move up towards that 125 level, and we've obviously had some price discovery on the euro US dollar as the German economy and the Eurozone economy has started to falter. So we've seen the euro US dollar come back down towards that 113 level. So keep that 113 level in mind as a benchmark. All the time we're trading underneath the 113 level, the euro does have the potential to slip lower, as being the 115 neckline of that bearish pattern. So if we do break above the 115 level, we should expect potential strength towards the 117 area. The 116.50 area is also a good target, and anything above there, we could potentially see an extension towards the 119 area if we do get some I don't know, positive Brexit scenario, some bearishness surrounding the US economy, something like that. We could potentially see that, but at the moment it does seem on a longer term basis that the euro US dollar is very much under pressure. If we have a look against the euro against the British pound, after a projected or protracted uptrend in that currency pair, we can see that finally now we are starting to retrace lower, and the key low is situated at the 0.8620 level. So we should expect medium term weakness all the time. We're trading below that 186.20 level, with the potential for further bearishness towards the 8300 level. You can see on there, you can see a series of lower trading highs there on the weekly time frame. So we can see that kind of signifies that the pair was struggling, and obviously Brexit's a major driver of this currency pair at the moment. So if we do see a positive outcome with Brexit, we could certainly see the 83 level tested. Below the 83 level, I don't see an awful lot of technical support underneath the 82 to 83 level, and we could potentially go all the way towards that 80 level. So that is an increasingly interesting cross pair to watch for the euro, and again at the moment Brexit's the key driver of that. Moving on to the euro Japanese yen pair, currently my technical outlook for this pair is currently range bound. We are seeing it trading below its 200-week moving average after testing it this year. We didn't we didn't move above it, so we have a slight negative bias on the euro Japanese yen pair. Obviously, the Japanese economy isn't performing, the European economy isn't performing, so we haven't seen a lot of action. You'll obviously see that the downsloping price channel prices tracked in that at the moment. Until we see a breakout from that price channel, we should obviously expect range-bound trading conditions, a bearish breakout, and we can probably see a down move towards the highlighted area between the 117 to 116 region. A break above the 200-week moving average definitely exposes a technical test of the psychological 130 level. So at the moment, the euro pairs, potentially the euro British pound pair, is the most exciting. The euro US dollar is possibly the most clear as far as a bearish trend, and with the European and the Japanese economies both underperforming, it's quite an underwhelming pair for formerly such a fast moving and exciting currency pair. I just asked Neville if he has any thoughts on that himself.
Yeah, I mean, in the first webinar, we talked about the interest rates and how that affects some currencies. So obviously the euro versus the US dollar, I would be more inclined to be short euro versus the dollar. But yeah, and there's like certain areas on the chart where I think there might be like little bounces and things. If I could just clear some of this off. Pen's not working. Hang on. Clear all drawings. Yeah, so I was going to say these like little pop-ups, consolidation, and then rallies. I think those sort of areas are proving to be sticking points for this downtrend. So if you like look across, like from right to left, the next, if we do break lower, which I believe we should be, then yeah, the next sort of point would be that little range there, and then down to this one here. I think they're the two clearest areas that I feel there'll be a pause in the downturn. So if we go down, pause there, and that is based on Europe, like we said, like Germany being sick, the euro area being quite sick, the dollar hopefully finding some strength with positive news and more a stable economy. That'd be good. And then with Brexit, I think a lot of the pound weakness has been on the uncertainty of what Brexit is. So maybe my personal opinion, I'm hoping that the pound finds some strength when there's some certainty whether we be leaving Brexit or actually achieving Brexit or it being revoked entirely. I think the British economy is doing slightly better overall, and the British pound should be a little bit stronger. Our interest rates are probably that could come into it as well, like the 0.75 versus the 0. I would definitely love to see that double bottom get taken out, just as a technical reason. You might get a push down and then come back up. I could imagine that happening. But yeah, it's all based on Europe being weak, the euro being weaker, and just finding some currencies which are either going to give you a carry trade or some sort of stronger yield. That's what I have to say on that one.
Okay, that's great. We've got about 5 minutes left of the webinar. If anybody would like to ask us any questions, please feel free to do so in the remaining minutes of the webinar.
That can be questions on the oscillators, the trend indicators, or our price predictions. We should thank them for turning up and listening to us for an hour.
Yeah, so if anybody doesn't have any questions, myself and Neville would like to Thank you very much for attending this webinar, and our next webinar, which is scheduled for April, we'll be discussing volatility and volume. So if you don't have any questions, I'd just like to thank you for attending the webinar, and we will see you all next time.
Yeah, thank you.
Thank you very much.